Chapter 16, Costs for Decision Making. Through this chapter, you're going to look at explanations and illustrations for some of the different cost terms, such as differential, allocated, sunk, and opportunity. Explanations on how costs are determined to be relevant for our short-run decisions. Analyze relevant costs for the following decisions: seller process further, special pricing, target costing, make or buy, continue or discontinuous segment, and product mix. Describing the attributes to capital budgeting and making it a significantly different activity from our operational budgeting. Explaining why present value analysis is appropriate and why we use it in capital budgeting. Defining the cost of capital and demonstrating its use in capital budgeting. Illustrating the use of and differences between various capital budgeting techniques, such as net present value, the present value ratio, and the internal rate of return. Describing how issues concerning estimates, income taxes, and the timing of cash flows and investments are treated in the capital budgeting process. Calculating the payback period of a capital expenditure project. Calculating the accounting rate of return of a project and explaining how it can be used most appropriately. And explaining why not all management decisions are made strictly on the basis of quantitative analysis techniques. The decision-making process begins with strategic, operational, and financial planning. Implementing the plans and executing operational activities provide performance data. After the data is collected, the performance is analyzed, and the feedback generated is used to continue to refine the process. This chapter examines several examples of short and long-run decisions and establishes a way of thinking about costs involved in the decision-making process. A relevant cost is a future cost that differs between alternatives. Relevant costs are differential costs that will differ according to alternative activities being considered. Opportunity costs represent income that is foregone by choosing one alternative over another. Irrelevant costs are allocated costs. They are common costs that have been arbitrarily assigned to a product or an activity. And sunk costs are costs that have already been incurred and they're not going to change. Opportunity costs are not recorded in the accounting records, but are relevant to making decisions because they are a real sacrifice. For example, if you are not attending college, you could be earning $20,000 per year. Your opportunity cost for attending college for 1 year is $20,000. You gave up $20,000 to attend college. So when you are determining costs, it's important to understand what is relevant, and especially whether it's short run or long run. So for example, will you drive or fly to Colorado for spring break trip? That's of course assuming that you were in some other state. As shown on this slide, there's a bunch of information that you're going to take into consideration to help you make that decision, such as the cost of motels per night, meal costs per night, what your car insurance is, kennel costs for your dog, the amount of gasoline for your car, the round-trip airfare or rental car for a week, how long it takes to drive, and what that's going to do as far as your time at your destination. Let's take a look at the analysis on this slide and compare the costs before we advance to our next slide. Note that the expenses for lodging, meals, kennel costs, and car insurances are the same, whether you drive or fly. The motel meals and kennel costs do not differ, so they are not relevant to the decision. Also, car insurance is not relevant because it is a sunk cost. It is going to have to be paid regardless. The transportation costs differ between the two alternatives, so those are what are relevant to your decision-making process. Are the 2 extra days in Colorado worth the $500 in extra costs to fly? This is what it comes down to, and this is the non-quantitative aspect of, is Colorado for 2 more days worth $500? That's going to be differently answered by different people. This is a perspective consideration at this point. If it was solely based off costs, then of course it would be drive rather than fly. Sometimes we have to make the decision to accept some additional business. And the decision to accept additional business should be based on what's called incremental costs and incremental revenues. Incremental amounts are those that occur if the company decides to accept new business. So let's look at Microtech Company, who sells 4,400 laptop computers. The company has revenues and expenses as shown. Each laptop sells for $2,400. Total manufacturing costs per unit equal $2,000. Operating income is $280 per laptop. Fixed overhead is based on a capacity of 5,000 units. So 2.5 million divided by 5,000 units is a $500 per unit allocation. Microtech receives an offer to purchase 500 of its laptops for $1,800 each. If Microtech accepts the offer, total fixed overhead itself is not going to increase, and a selling commission will not be paid on the computers in the special order. Should Microtech accept this offer? So what we do is we go and we do a special pricing decision to determine if the special order will contribute to the bottom line. Note that the fixed overhead and sales commissions don't change and will not change should the special order be accepted. The special order of 500 units at $1,800 per unit will net the company $150,000 in additional operating income. So the special order would bring in the $900,000. There would be $400,000 in direct materials, $225,000 in direct labor, and $125,000 in variable overhead. These are all things that would change as a result of the special order. There would be no change in fixed overhead, so we would make that 0. And there would be no sales commissions, so we make that 0. This means that by taking on this special order, there would be an additional $150,000 in operating income that we would experience. Because this is positive, we should accept the decision as long as the additional units are within the relevant range and we have the capacity to create those. If Microtech accepts the offer, net income will increase by $150,000. We can reach those same results much more quickly by using a contribution margin calculation. Special order contribution margin per unit is going to equal 300. That is 1,800 minus 1,500. Therefore, operating income will increase by $153,000. $300 per unit multiplied by the 500 units. Another decision that you would have to go through is a make or buy decision. Should I continue to make a part or should I outsource it and buy it? What will I do with my idle facilities if I buy that part? The relevant cost of making a component is the costs that can be avoided by buying the component from an outside supplier. A decision rule is that costs avoided must be greater than outside suppliers' prices to consider buying the component. To illustrate this, we're going to use Microtech again, who currently makes the motherboards used in its laptop computers. Unit costs for manufacturing the motherboard are shown here on the slide. An outside supplier has offered to provide the motherboards at a cost of $300 each, plus a $5 shipping charge per motherboard. 20% of the fixed overhead will be avoided if the motherboards are purchased. Microtech has no alternative use for their facilities, so the question is, should Microtech accept the offer? The differential costs of making, the costs that are avoided if bought from an outside supplier, are shown on this slide. The differential costs are $270. They would avoid $270 of costs if they purchased from an outside supplier. This is less than the $305 per unit that they would pay the outside supplier. Microtech should not pay $305 per unit to the outside supplier to avoid $270 per unit differential costs for making the part. There's a $35 disadvantage. Now remember, this is because also Microtech has no alternative use for their facilities. Another thing that we regularly have to consider is continuing or discontinuing a segment. We talked about that a little bit with the repair parts division in a prior chapter. Operating income from cruisers is in total $152,000. Notice that the repair parts division is showing an operating loss. Why not just discontinue the repair parts division and increase operating income by $24,000? That's kind of what a snapshot off the cuff look would suggest. What's important to take into consideration is that total fixed costs are allocated to the repair parts division in the amount of $184,000. Direct fixed expenses of $120,000, and then common fixed expenses of $64,000. Take a minute and remember what happens to common fixed expenses when the repair parts division is eliminated. Those common expenses will continue to exist and would be reallocated to the sail and motorboat divisions. Total company income is $152,000 with the repair parts division, but it would only be $112,000 if we were to discontinue the repair parts division. In other words, the operating income would actually decrease $40,000 if we were to eliminate the repair parts division. This is why we can't snap judgment completely off looking there and seeing that it has a net operating loss. There is those common expenses that have to be taken, common fixed expenses that have to be taken into consideration. Now next, we're going to talk about the short-term allocation of scarce resources. Managers often face the problem of deciding how scarce resources are going to be utilized. Usually, fixed costs are not affected by this particular decision, so management can focus on maximizing their total contribution margin. Integrated Technologies produces 2 products. And here's some data about those products. We have the selling price per unit, the variable expenses per unit, and the contribution margin per unit, and the time it requires to create that product in hours. Product 1 has a contribution margin of $150 and uses 2 hours processing time. Product 2 has a contribution margin of $100 and uses 1 hour of processing time. If there are 120 hours of processing time available, which product should be produced? Let's calculate the contribution margin per hour of processing time. The contribution margin per hour for product 1 is $75, and it is $100 per hour for product 2. Product 2 should be emphasized. It is the more valuable use of processing time, yielding a contribution margin of $100 per hour as opposed to $75 per hour for product 1. There are no other considerations, no other factors to take into account. The best plan will be to produce enough products to meet the current demand for product 2, and then use any remaining time to make product 1. Next, we move into the concepts of capital budgeting. Managers must plan significant outlays for projects that have long-term implications, such as the purchase of new equipment, the introduction of new products. Capital budgeting involves analyzing long-term investments and deciding which assets to acquire or sell. Capital budgeting analysis outcome is uncertain. Large amounts of money are typically involved, and investments involve a long-term commitment. These decisions may be difficult, if not impossible, to reverse. So it's important that when you go into long-range implications, that you do so with a lot of forethought. And to do this, we do use accounting data. Decisions must be made for plant expansion, for example. Things like new equipment, office innovation, and there is a limit to the amount of investment funds any organization has. Business investments extend over long periods of time, so we must recognize the time value of money. Investments that promise returns earlier in time are considered preferable to those that are going to have promises of returns later in time. One of those considerations is the firm's cost of capital. The cost of capital is usually regarded as the most appropriate choice for the discount rate used to calculate the present value of the investment proposal that's being analyzed. The cost of capital is the average rate of return the company must pay to its long-term creditors and its stockholders for the use of their funds. There are multiple methods that we can use in our capital budgeting techniques. Methods that use present value analysis include the net present value and the internal rate of return. Methods that do not use present value analysis are payback and the accounting rate of return. So let's look at each of these methods a little bit more in depth, starting with net present value. Net present value is a comparison of the present value of cash inflows with the present value of cash outflows. To calculate net present value, you choose a discount rate, the minimum rate of return, and you calculate the present value of the cash inflows and calculate the present value of the cash outflows and subtract the cash outflows from the inflows. If the net present value is positive, the project is acceptable, since it promises a return greater than the cost of the capital. If the net present value is 0, It is considered acceptable since it promises a return equal to the cost of capital. And if the net present value is negative, it is typically deemed not acceptable since it promises a return less than the cost of capital. So let's look at an example for Box Mover Incorporated, who is considering the purchase of a conveyor costing $16,000 with a 7-year useful life and a $5,000 salvage value. Annual net cash flows are shown in the table on the following slide. Box Mover's cost of capital is 12%, and we're going to ignore taxes for this purpose. So let's compute NPV for this investment. This slide shows the net present value calculations for the 7 years of cash flows plus the salvage value on the sale of equipment. So in year 1, with $4,000 of annual cash flows, we go to the present value of one factor, and that results in $3,571. In year 2, discounted 12%, the present value of one factor, we get $3,348. So on and so forth, all the way down to salvage, which would be at 7 years, 12%. Discount factor for present value of one factor of 0.4523. So we would have total cash flows of $21,436. For an investment, those are cash inflows, for an outflow of $16,000. There is a positive net present value, which indicates that this is a project that is going to earn more than the 12%, so the investment should be made. Profitability index is the present value of cash inflows divided by the investment required. The higher the profitability index, the more desirable the product. Here we have investment A, which has a present value of cash flows of $81,000. It requires an $80,000 investment. This project A has a profitability index of 1.01. Investment B has a present value of cash inflows of $6,000 and requires a $5,000 investment. Thus, it has a profitability index of 1.20. Of these two, investment B is going to have the higher profitability index and thus is going to be deemed the more desirable project. This is when you have only a certain amount to invest and you are looking at allocating it amongst various investments or projects. The internal rate of return is the actual rate of return that will be earned by a proposed investment. It is the interest rate that equates the present value of inflows and outflows from an investment project. The discount rate at which NPV is going to equal 0. Let's look at an example for Decker Company, who can purchase a new machine at a cost of $104,322. That will save $20,000 per year in cash operating costs. The machine has a 10-year life. In this example, future cash flows are the same every year, so we can calculate the internal rate of return. The present value for the internal rate of return equals 5.2161. This is the investment required divided by the net annual cash flows. So 104,322 divided by 20,000. Using the present value of an annuity of one table, we find the 10-period row, move across, and we find the factor of 5.2161. We go to the top of the column and we find that that is a rate of 14% for an internal rate of return. Decker Company can purchase a new machine at a cost of $104,322 that will save $20,000 per year in cash operating costs. The internal rate of return on this project is 14%. If the internal rate of return, 14%, is equal to or greater than the company's required rate of return, then the project is deemed to be acceptable. Some analytical considerations are sensitivity analysis and post audits are helpful in dealing with estimates. Cash flows far into the future are often not considered because of the level of uncertainty and a small impact on present values. Cash flows are assumed to occur at the end of the year, and some projects will require additional investments over time. Often, after-tax cash flow can be estimated by adding back depreciation expenses to net income. An increased working capital is initially treated as an additional investment, a cash outflow, and as a cash inflow if recovered at the end of the project's life. Least cost projects, often required by law, will have negative NPVs. So let's look at Jones Company, who's considering purchasing a machine that costs $55,000 with a 5-year life and a $5,000 salvage value. The analysis indicates that after-tax income will be $6,600, but this includes depreciation. Most capital budgeting techniques use annual net cash flow. Depreciation is not a cash outflow. Therefore, it must be added back to arrive at an annual net cash flow. Annual net income is $6,600. When we add back annual depreciation of $10,000, then we get an annual net cash flow of $16,600. Payback period is another analysis technique. The payback period of an investment is the number of years it will take to recover the amount of the investment. Managers prefer investing in projects with shorter payback periods. This makes common sense. For example, Texaco wants to install a machine that costs $17,000 and has an 8-year useful life with a $1,000 salvage value at the end of its life. Annual net cash flows, including salvage value, are irregular over an 8-year period. The payback method determines that Texaco recovers the $17,000 purchase price between years 4 and 5, about 4.75 years. Interpolation may be used to arrive at a fractional number per years. This method ignores the time value of money, and it ignores cash flows after the payback period. So in considering 2 projects, each with a 5-year life and each costing $6,000, Project 1 provides a steady cash inflow of $2,000 for 5 years. Project 2 provides a steady cash inflow of $1,000 for 4 years. But in the 5th year, the cash inflow jumps to $1 million. Project 1 has a payback period of 3 years, whereas Project 2 has a payback period of 4.002 years. Would you invest in Project 1 just because it has a shorter payback period? Project 1 would be accepted because the payback period focuses on the amount of time to recoup the original investment, and then it ignores all future cash flows after the payback period. This may not be the appropriate decision-making tool for these particular projects. Whereas the accounting rate of return focuses on accounting income instead of cash flows. Remember, those are different. Accounting rate of return equals operating income divided by the average investment. Let's reconsider the $17,000 investment being considered by Texaco. It has annual operating income of $2,000. We're going to compute the accounting rate of return. The machine costs $17,000, has an 8-year useful life with a $1,000 salvage value. There are depreciation expenses of $2,000 annually. The accounting rate of return equals operating income divided by the average investment. That's beginning book value plus ending book value divided by 2. The average investment is $16,000. That's $17,000 plus $15,000 divided by 2. Therefore, the accounting rate of return is 12.5%. As we saw with the payback method, a serious flaw of the accounting rate of return approach is that the time value of money is not a consideration. In addition to the consequences of various quantitative models, management's investments decisions are largely influenced by qualitative factors, such as a business segment that requires some special consideration, mandatory regulations and goals, technological developments within the industry, and limited resources and capital rationing.